Well, good morning, everyone, and thanks for sticking with us for a couple of minutes as we addressed a couple of technical issues for today. A couple reminders with the series in general. We do hold this workshop every month on the first Thursday of the month at 11 o'clock, so mark your calendars in general for that. We record our sessions as well. So you can go back and watch recordings of past month sessions at any time you want. There's no login or password or things required to watch any of those past ones. And there's probably several years worth that are out there on our website. We do take some of them down once they get particularly dated, but in general, there's a pretty good library there as well. So a couple other kind of housekeeping notes for today. You're always welcome to send in questions via the chat window at any time. If you don't want your name known of who the question came from, send it to me specifically. And when we get a break in the presentation, I'll simply say we've had a question come in and we'll get a chance for our presenter to address that question. Also, at the end of each session, we'll also encourage anyone that wants to, if they'd like to unmute and ask any questions to our presenter that way. We're happy to do that as well at the end of each session. So the sponsors for today's event, Montana Small Business Development Centers, the Montana Department of Commerce, Small Business Administration, Montana State University Extension, Montana Economic Development Association, University of Montana, and Grow Great Falls Economic Development all partner to bring this series to you at no cost. So we do appreciate each of those sponsors contributing in the various ways that they do that. So now moving on to today's presentation. So I'm really happy to have Sarah Hamlen joining us. Sarah is a financial advisor with Thrivent Financial. Also happens to be a former colleague of mine when we worked together some years past. So that made it much more relaxing for me, even as we addressed a couple of technical issues, knowing that we'd get worked out and that Sarah would be flexible in terms of working with what we could do in terms of the technology for today. So Sarah is going to talk to us a little bit about business valuations and kind of why that's important to folks. So Sarah, I will go ahead and turn it over to you, and excited to hear what you have to say today.
All right. Well, thank you so much, Joel. I apologize for issues with our video feed today, but hopefully the screen is sharing and you can see the presentation, which is the more important element of today's conversation. By way of a little additional introduction, I am a financial advisor with Thrivent. I've been in this career for over a decade, and in my capacity as a financial advisor, I am fully self-employed and have a business partnership with two other advisors out of Brenham, Texas. We operate a team of 5 advisors and 5 support staff in both Texas and Montana. So when we talk about business ownership and we talk about issues of business valuation and what that's all about, just know that I too am in that small business owner space. So our topic today is really getting into what is your business worth and why does that matter to us? And hopefully by the end of today's conversation, you'll have a better idea of what valuation entails, as well as being able to make a decision about whether or not it's right for you. I do want to fully disclose that I am not in the business of selling certified financial or business valuations. So today we're really just talking about how I, as a financial advisor, use this information in working with businesses on succession planning or transition planning, sometimes estate valuations, so that you can maybe better understand why we need that information to make informed decisions. You know, Franklin was keen on saying that an investment in knowledge pays the best interest. And I know we all appreciate the value of good information, the value of education. But when we're business owners and we're allocating scarce resources, we also know that we have to be wise with our money and make investments at strategic times. So again, hopefully by the end of today, you have a better feel for whether or not this is something that you might want to engage in. The interesting thing to me about business valuations is that the current statistics, depending on who you talk to, which data sets you're pulling, say that between 75 and 80% of all micro to small business owners plan to exit their businesses within the next 10 years. And many of those are saying that they're within the next 5 to 7 years. And yet we're seeing very few of those business owners actually know their own business valuation. About 2% of current small business owners have true valuation numbers in place according to IBS World. So if we're saying that this is important information and it's necessary for us to make good decisions in transitioning or selling our businesses, why are more people not getting this information? In my practice, we do a lot of extensive planning with people, and sometimes that's in intense estate planning, sometimes it's farm and ranch succession planning, oftentimes it's business planning, and I tend to find the barriers to moving forward on planning elements are the same no matter what the topic might be. So the first red flag that gets thrown by business owners in particular is there's an expense associated with it. I have scarce dollars that I need to allocate. I need to, invest in other things. I don't know that I want to pay for knowledge or for legal documents or for whatever the planning element might be. So there's always an expense concern. We know that time is a valuable resource to us as small business owners, and unfortunately, it's a scarce resource that's constantly being pulled in various directions. We get done dealing with an HR issue, now we have to go deal with a production issue, then we have some sort of thing that the accountant needs to file our taxes. Our time is scarce. And so often the idea of diving into a new subject or taking on another project is just an off-putting piece for business owners. The third thing I hear, and it's probably the most common thing I hear as a barrier, is the term "it's complicated." And over my time in practice, what I've come to understand is when someone says it's complicated, it doesn't actually mean that the subject matter is that difficult. What it means is I don't necessarily speak that language fluently. I don't know what questions to ask. I don't know what to expect as both an input and an output of this process. And for me to engage in this in a meaningful way, I'm going to have to spend some time and I'm going to have to expand my knowledge. And that adds stress, it adds some anxiety, and therefore the culmination of expense, time, and complication means we just say not now. I'm going to procrastinate and not get this information. If there's one tip I could give you when it comes to business valuation, it is do not wait until you're at the precipice of a decision to get a valuation. As we'll talk and go through some more examples here in a bit, what I'll tell you is that most of the time when people come in requesting valuation information, it's because someone has just passed away and we need to know the value of their estate. We've got a sale pending, a buyer has shown up, or we've just reached some sort of emergency point in our lives where we need to exit the business. And really, we can get valuation information in those situations, but we can't make decisions to change the information at that point. We're just kind of riding the horse we came in on. And as you'll see when we go through some of these examples, oftentimes if we have good information ahead of time, we can make different choices and maybe change the way that we're presenting information, but it can take time to make those changes occur in our financials. At the same time that we're saying, it's not necessarily the right time for me, I'm worried about going through this process, we do have a lot of information that comes from evaluation that's valuable, such as how should I grow? Where do I invest my capital in order to get the best return on my investment? Should I restructure? How should I restructure? Should I sell? When should I sell? And those are the types of information that we can really get our arms around when we have a good valuation in place. Well, that might sound just great. It's often hard to know, what would be involved in evaluation, what kind of output might I get, and what would it tell me about my business? So I appear to be frozen.
It still looks good on my end.
But did this slide didn't advance, did it?
We're on the slide that ends with any time.
Well, it appears we're having another technical difficulty, but that's okay. I'm going to walk through the 5 pieces of what you can expect in evaluation, and hopefully our technology will decide to cooperate by the time we get there. The first piece that you really get out of evaluation is just knowledge about what the business is worth. We get a number on the value of that enterprise, and that can be really important. Oftentimes our businesses are one of our biggest assets. And so when we, I'm going to just try to stop really quick here and dive back in. I apologize for the technology.
If you want to email me that slide deck, I can also share from my end as well. Yep,
I'll do that real quick and then I'll have you pull it up, Joel. But in the meantime, I'll just keep going and we can hopefully get some visual aids for you here shortly. The first piece that we get is just a number on what is this business worth. And like I said, most of the time our businesses are one of our biggest assets. So if you were asking me to handle an investment account for you and you called and said, what's the value of my account today? And I said, well, I don't know, it's somewhere between 500,000 and $2 million. I would hope that you would fire me as a financial advisor because that's really not an acceptable answer. I should be able to tell you the value of your asset. And yet, when we work in our businesses, a lot of times we do just that. We say, well, this business might be worth 500,000. It might be worth 2 million. I maybe could put it on the market for this. I wouldn't sell it below this, but we really don't have a good grounding for what that number really is in our specific situation. So the first thing we get is just a number. What is this thing worth? And how does that really line up with our expectations of what it might be worth? The second piece, I'm going to apologize for doing a bit of a rabbit trail on, but what we can often get out of our valuations as well is some information about protection strategies. In protection strategies, there are a number of places that we can help to protect our businesses, but I'm going to give you an example of Jack and Jill. And I promise you Jack and Jill's names have been changed to protect the innocent, but they are a real life case that we're working with right now in our practice. Jack and Jill worked together as colleagues in another business, and they recognized that they actually got along really well and that they would be able to operate another business very successfully. And they were right. They got into business together, they formed a corporation, and they ran it really well for a number of years. They always meant to go to the attorney and get those pesky business documents like buy-sell agreements or operating agreements done, but they didn't actually have that happen. Unfortunately, Jill passed away, and Jack now found himself in business with Jill's husband. There were two small problems with that. One is Jill's husband was not Jill. He'd never worked in the business. He didn't know anything about what they did on a day-to-day basis. And somewhere in the back of his mind, he got it in his head that Jack was pulling the wool over Jill's eyes and that this business was actually worth a lot more than what Jack was trying to tell the family it was worth. So he refused to sell his shares. Unfortunately, after a couple of years of not being able to buy out the husband, he died. I kid you not. This is an actual case that we've been working with the owners on. But now Jack found himself in business with the two sons. One of the sons agreed to be bought out and was fairly reasonable about the process. The other son is just not a good human. He has wage garnishments from a variety of women because he owes child support. He decided at some point in his life that he was not going to pay income taxes, and the IRS apparently doesn't agree with that. And so he did not want to be bought out because he knew that a lot of that money was going to be garnished immediately on receipt. But also he had his dad's voice in the back of his head that said, this business is worth a fortune. If you just hang on long enough, maybe these garnishments will go away and you will seek your fortune in the wide, wide world when this business sells. We ultimately were able to negotiate a sale of the shares with this gentleman. But in the process, Jack incurred over $880,000 worth of personal debt, which of course some of this was negotiated in the last year when interest rates are not favorable. And it's taken him more than 7 years to extricate this family from his business, which has required legal fees, accounting fees. It's been complicated. In the meantime, Jack's been doing 100% of the work for 50% of the profit. So it's been a long and drawn out story for this family. We would not even have a story to tell about Jack if he had a good protection strategy in place with Jill when they first formed their business. A buy-sell agreement that stipulated that the shares of the shareholder would be sold at the time of the death of a shareholder would first of all have given Jack the right to buy out the business. A valuation would have said this is what these shares are worth and this was what the value of the business is. No matter what you think it might be worth, this is the true value of the business. And a life insurance strategy on Jill that provided Jack immediate liquidity to buy out the family would have meant we had no story about this particular business. Unfortunately, most of our businesses don't have good funded strategies in place. So a valuation can give us information about what that business is worth, and then it can help us to put some of those other pieces in. The other protection strategy that's a little bit of a dovetail to the buy-sell strategies and to valuation is making sure we have good key man or key person insurance on hand. In the case of Jack and Jill, not only did Jack have a major constraint in trying to get rid of the family members in the business after Jill died, he also had a cash flow constraint. Jill was his business partner because she drove 50% of the revenue for the business. And so having another life insurance contract on her that would have provided the business liquidity to deal with the fact that she wasn't there to make product and to drive revenue, but also to hire in someone who could operate at her skill level and level of expertise would probably have come at a premium. Of course, Jack didn't have either of those pieces, so he ended up just having to cash flow things on his own. So I apologize for the little rabbit trail on protection, but unfortunately, I feel like a lot of times we just don't talk about it, and it's an important part of being in our businesses. The third piece is knowing and planning for your future. I work with people all the time who say, I really have not saved very much for retirement because I'm putting all of my investment into my business. That's where my resources are going. And there's nothing wrong with that, unless we're starting to make assumptions about the value of the business that are not accurate. So the first piece that, or the first example I'll give you is a gentleman I'm working with right now who came in and said, I know my business is only worth $3.5 million. And he's very analytical. He had a lot of reasons that he thought his business was worth $3.5 million. He had a potential buyer in the wings. When we started going through the valuation process, we found that his business was actually worth closer to $6 million. So had he sold at $3.5 million, the buyer would have got a heck of a deal, but he would have left a lot of his assets on the table. So we need to know the value if you're estimating too low. On the other side, I worked with a woman a couple years ago who was convinced her business was worth $4 million. She didn't have any information to substantiate that claim, but she started to set herself up for retirement as though she was going to have this $4 million nest egg. She bought a home, she bought vehicles, she decorated the home, all assuming she was going to have this affluent lifestyle when she retired. Her business was actually worth closer to 1.7 million. And so when she actually put her business up for sale and first had gotten a valuation that she didn't agree with, but put her business up for sale, found that the actual value was less than 2 million, she had to go back and make some changes in her future planning because she just couldn't cash flow what she thought she would. So if we're going to plan for the future and make predictions about our retirement or about our next steps in lives, let's get accurate information about what your businesses are actually worth. I'm going to come back to making better decisions when I talk about a future slide here, but the best analogy I can give you to making better decisions is if you were going to sell a home, we know that there are places where you can invest in improving your home that will give you return on investment. We all know that you can go to the University of Google or you can talk to your realtor about, do I take out the janky rug in the rec room or do I put new knobs on the kitchen cabinets? Should I repaint? Should I fix up the front yard? Where is it that I put my money if I'm going to sell my home that will make a buyer pay me more for that property? The same holds true with our businesses. If we have a better idea of what's driving the value of the business, we can decide where we want to invest in order to get the best return on investment. So again, I'll get into some of those performance indicators here in a bit, but evaluation can be really important to help us understand how we invest going forward. The reason I recommend, though, to get this information going earlier rather than later is to know your potential. And the best way that I can illustrate this is to say that oftentimes the financial documents that were presented by a business do not tell the story that the business owner wants to tell a potential buyer, or more importantly, a potential buyer's lender. So one of the more common things that I see in businesses is that this time of year we go to the accountant and we say, oh goodness, I'm paying too much in taxes. You've got to help me get rid of some of that self-employment tax. You've got to help me reduce my income tax. What can we do? And so a common strategy that's recommended is we'll put down a reasonable amount of wage compensation, but we'll take dividend distributions or owner draws out of the business to provide you a more tax-friendly personal income tax. And that sounds great, but we know from basic accounting that when we're taking a dividend draw or an owner distribution, or an owner draw or a dividend distribution, apologies, that's a distribution of equity. So when we run a business valuation and we've been taking the equity out of the business in order to meet our own personal cash flow needs, we maybe have been very profitable, we maybe have a really comfortable lifestyle, but the story that our books tell is that there's not much equity in this business. The other major driver that we can see in evaluation, and this is just one example, is that when we take a strategy like that, we can't demonstrate the amount of owner compensation very well. So a potential lender does not want to see that they're going to make a multi-million-dollar loan to a potential new business owner who's going to work 90 hours a week. And even though the business cash flow is fine, that owner is going to take home $40,000 a year. They want to know that that business owner is going to be comfortable and going to be happy in the business because they want them to stick around and repay their loan. So if we've taken creative ways to distribute cash from our business, but we're not telling the story of what the owner actually receives as a result of the ownership in this entity, we can make it look less valuable on paper. Now, I'm not a CPA. I don't want to pretend to be a CPA, and I don't want you to take this as an instruction on what to do with your cash flow. I'm just saying that when we go through the business valuation process, we can understand what the story is that your current financials are telling and make sure that that's accurate to what you want to portray. Again, when we get into the valuation process, we really can find that the information that you think is coming through your books is maybe not coming through the way that you expected. And it can be really important to get that information ahead of time. I'll get into a few more pieces that we can get in evaluation in just a moment, but one of the questions I get from business owners is, if I engage in this process, what could I expect to get? Like, what is the valuation going to tell me? And we do have a software that we use in our practice. It's called Biz Equity. That is not a certified valuation. It just kind of gives us a feel for where a business might be at. And this is a sample of the output that we might get from a valuation. It's similar to what you get if you purchase a certified valuation. Usually the valuations will say, using this methodology, the value of this business is between this dollar amount and this dollar amount. Using another methodology, it's between this and this. And by the time we aggregate all of the different methodologies, we can get a pretty good feel for the range of value in that business. In this example, we're showing an equity value and an enterprise value, which are very similar. Sometimes those are disparate, and we have to then kind of ask why. The asset sale value would be if we were to come in and strategically dismantle this business or start selling it off for market value of its parts and pieces. You know, what would that be worth? And then we also usually show a liquidation value of if there's a sole proprietorship, Joe runs the business, he's the only one that can really run this business, and he's not there anymore. If we had to come in and fire sale the business, what would it be worth? And that's what that liquidation value really reflects. So again, this is only one example of some output you might expect, but usually we get a range of values that we can use to better understand where things are at. A low cost, no cost place that you can start if you're thinking, I might want to start getting some valuation information pulled together, but I don't know if I need a full certified valuation at this point, is to start running your key performance indicators. And we know from business accounting, as well as maybe talking to our lenders, there are a lot of ratios that we can run that tell us how our business is doing. When we're busy, we're running our day-to-day operations, we maybe know we need to calculate some of these key performance indicators, but we don't always do them. So these are just simple math equations. You can pull up your own books, you can put things into a spreadsheet, and you can do this with little to no expense on your own, just to see where you're at in terms of debt to equity, fixed asset turnover, inventory turnover, interest coverage, you know, the basic financial indicators that we use to evaluate businesses. I recommend doing this because there's two things that I tend to find. One is, especially in rural Montana and rural Texas, our clients have really good P&Ls. We know where our income comes from. We know all of the sources and how profitable we are on our income. We have to report all of our expenses, both because we want to write them off and because we want to know where we're at on the P&L. So we tend to do a really good job of our P&L. Our balance sheet is often left kind of flapping in the wind. And so one of the first things that I find when we go through this process with businesses is that if we start to look at your numbers and we see something that looks strange, the first place we go is to the balance sheet of, is there something that is just a function of recording in our books that could be changed to tell that story differently or to get us a different result? And oftentimes there is something that we're coding perfectly well in the P&L, but when it flows through to the balance sheet, it's not quite categorized correctly. If we catch that early, we can start making changes to your books that tell a totally different story about how your business is performing. If you have a buyer on the line and the lender's asking for a valuation and they just have to crank out the numbers based on your current balance sheet, we may not have the time we need to make that type of an adjustment. So getting information early is important, and making sure that it's telling you what you want to see is also very important. Once you pull in your own numbers, I do recommend that you try to get some national industry data to compare how you're doing in your field relative to your peers. For example, on inventory turnover, if you're selling Sherman tanks, your inventory turnover is going to be very different than if you're selling tubes of toothpaste. So we don't want to use an inventory turnover number that's just kind of a broad national average. We want to make sure it's kind of indexed to your industry. Sometimes we find that that national data isn't relevant. I'm working with a business right now that deals with automobiles, and they're in a more rural market. The growth percentages and some of the growth statistics that we see on the national level just aren't relevant to this business. In a more modern or a more metropolitan market, there's unlimited drivers, therefore there are unlimited vehicles that they could potentially work with. In a rural market, there are only so many licensed drivers, and therefore we have kind of a finite number of automobiles he could work with. So we know that the growth percentages might not be correct, but the rest of his KPIs are, blowing out. He's blowing the competition out of the water in terms of how he performs. So if we can explain away some differences, that makes sense. Other times we get in and we see, no, you're really lagging your industry peers on a number of fronts. And that tells us where we need to focus our attention and where we need to maybe drive some of our investment in order to change our numbers overall. So again, if you want to get into this, usually industry associations have good data on KPIs. You can get a lot of information from the small business development centers. The information is available at low or no cost. So this is just kind of a function of devoting time to spending more attention in your books. So with that, I will, in theory, stop our presentation here and be happy to field any questions. I hope that by just kind of talking through a little bit about what's involved in evaluation, you've gotten a better feel for what you might expect in the process, as well as what some of the outputs might look like. I won't pull the wool over your eyes and tell you that it's not an investment to go forward with evaluation. Usually I tell clients to expect somewhere between a $3,000 and $10,000 investment to get a full valuation. And usually if we're getting true business appraisers involved, we're looking at between $5,000 and $10,000. So this isn't something that you just want to willy-nilly kind of go out and throw cash at. But there are places that you can get either some software outputs, or you can start running your KPIs to start to get a feel for what your business might be worth. In general, though, I just encourage you to get as much information as you can about what's happening in your books and make sure you really understand how that flows through and what kind of story it tells to a potential buyer or to a lender in the event that you do find an opportunity to transition. So with that, Joel, do we have any questions, concerns that I might address?
We do. We had two questions come in, and for those that are on, be thinking, because after I ask these two, I'll open it up for more questions from the group. So the first question is, how often do you recommend a business get a valuation, and are there certain milestones that might trigger a need for a new valuation?
Absolutely. I recommend that once you have a valuation, you don't need to do one every year, but you can usually see from that data where your opportunities to drive growth come from. And often in the valuation, it will give you information about strategic investment in these fixed assets or in this inventory reduction or whatever it is would improve your value. So from that, you can get a feel kind of for the pace. If you're having rapid growth, and especially if you're trying to put protection strategies in place, we do need to keep an eye on how much your valuation is changing on a regular basis. For example, in the protection strategy piece, if we're seeing a business that's growing at 30, 40, 50% over the course of several years, and we put in buy-sell insurance in year one, well, if that owner dies 5 years later, we don't have enough insurance in place to buy the shares because the business has grown that rapidly. So if you have some things going on in the business, or you have a major change, you've acquired new assets, you've sold some assets, those might be kind of those milestones that you'd look at. If you can find a software, like I mentioned, we use the Biz Equity tool. There are a few others out on the market. If you can find those, you can update your information pretty quickly. And that can just be some slide rules of, yep, grew 20%, and just slide it along and see what your valuation does. It's not certified. It's not something you can take to a lender, but it at least gives you as a business owner a feel for where you're at.
Right, thank you. The second question that came in while we were going along is, it says, if my current partnership agreement doesn't address my ability to buy out my partner if he were to pass away, do I need a legal amendment to my partnership agreement or just a vote at a meeting?
I would strongly recommend a full legal revision. And I'm not an attorney. I don't play one on TV or any of the things, but what your operating agreement and your buy-sell agreement provide are those legal frameworks. Heaven forbid you ended up into a litigation situation with a family. You want to make sure that document is not just, we agreed on it at the break room, but that it's a notarized document that your attorney drafted. And ideally, both your operating agreement and your buy-sell agreement discuss what that succession looks like, and how decisions are made within the business about either adding partners, removing partners. If someone's disabled, what do they do then? How's that different than if they pass away? And what are the obligations of the firm in that eventuality? The other small caveat that I would add there is, a lot of times I find buy-sell agreements don't include the provision for treasury stock. And what I mean by that is, in the event that, like in my business partnership, our buy-sell agreement says that we will buy out the family and make them whole, but I may want the firm to buy those shares. I may not have a business partner that I want to have buy those shares for whatever reason. Either we have nobody that's interested in buying it, or we have a partner that's maybe coming in at a low level, but we're not ready to offer them a substantial interest in the business. I may want treasury shares that allow the business itself to own those shares back from the shareholder. So again, a good time to get with an attorney, make sure your documents are up to snuff. And thank you, first of all, for having operating agreements, because most of our businesses don't. So.
All right, well, that's helpful. So with that, let me open it up here. If anybody wants to send in another question via the chat window, or if you want to unmute and ask a question, now's your time.
I have a quick question. Generally, when you're working with businesses that are thinking about transitioning, what advice do you give them for kind of an ideal timeline in order to kind of get their accounting and their numbers up to be an attractive candidate to be purchased?
I certainly within 3 to 5 years, you should at least have some idea. And if you're beyond that timeline, you're where you are. Earlier is better. And the biggest reason is, like, for example, I did a valuation with a business a few years ago they weren't doing any fraudulent accounting, but they were creatively or strategically distributing cash flow to other enterprises in order to mitigate taxes. Unfortunately, when they went to do a business valuation on just the discrete unit that they wanted to sell, it didn't show that it cash flowed very well because of how they'd been extracting value into other enterprises. And so for us to make that change and be able to have books that actually substantiate what that business was able to do, we need at least a couple years of accounting that would show the actual cash flow in that business. So it can take, usually a lender is going to ask for at least 2 years of financials, probably 3. So if we can get within that 3-year window of, like, yeah, if we need to make a change or we need to change the way we're doing something in the balance sheet, we have a chance to address that concern, as opposed to, oh, darn, the buyer's here and I can't really offer it up for the value that it's worth because my numbers just don't substantiate it. Is that helpful?
Yep, thanks. Yeah, and what you said too about the businesses really knowing their P&Ls but not their balance sheet certainly rings true for, I'm a SBDC advisor, so we see that all the time. The P&Ls are easy to understand and follow, but once you hit the balance sheet, things kind of go out the window. So
Yeah.
say that.
Yep, a lot of times the BS abbreviation for balance sheet is very applicable. So.
All right, thanks for that question. Are there other questions? Well, Sarah, did you have any final comments you wanted to share with the group?
I don't, other than thank you so much for the interest, and please feel free to reach out. Joel, is my contact information included in the transcript?
I believe it will be. If not, people can email me directly and I'd be happy to get you in touch with Sarah. So
perfect. I'm always happy to field questions. I love this topic and love working with businesses. So I'm very happy to provide any and all information I can.
all right, well, thank you very much for your presentation and for working through the technical issues with our web platform today. For those of you that are on, please mark your calendar. April 4th at 11 o'clock will be our next monthly webinar series, and we'll get a topic finalized and announced here shortly on our website. So with that, everyone, have a great day, and I hope to see you in April.
All right, thanks so much, Joel.
Thanks, Joel.
Bye.